Hey, it's Trader Tim from EminiMind, and it's Monday, March 13th, doing a market analysis video. Wanted to run through a handful of trades and also talk about what you can do when volatility increases to kind of manage your risk and still be able to take some meaningful trades. So the first thing I wanted to touch on is this large kind of big picture, and we'll zoom into where we're at right now. So on a monthly, larger time frame, talking, decades here, we've got large 50% retracement that kind of took us up to the 2020 COVID sell-off. We didn't make it all the way to the 50%, but we made it close. And just like we didn't make it all the way to the negative 23 on the upside here, but we made it fairly close. And then if we go down to a little bit smaller time frame on the weekly chart, we can see the 50% retracement from COVID lows to all-time highs. That's what we kind of came into this year, having touched at the end of last year, like October of last year, and that's down in here. We bounced to the 50% short at the end of last year, and then I've left that drawing up. So whether you're trading intraday or on a daily chart, it's important to leave any drawing, like a retracement drawing or level in general, that trades once, that has some kind of target. You want to leave that up as opposed to readjusting your anchor points just throughout the trade. Before, if it doesn't hit its target, then you need to leave the anchor until it either hits its target or breaks, in this case, the 61.8. So if we go down even further to the daily chart, now we have, here's that 50 short above us, the full halfway back below us, and then kind of dissecting in the middle is where we open today at the full halfway back. One thing that really gets talked about so much is this, fear of recession. And one of the things that we talk about a little bit in the Tuesday live sessions is that recession is really not a big deal. There's been lots of recessions, and what people associate with a recession is not this big R word of recession. It's the loss of their job and the inability to make their payments, and thus the risk of losing their house, their car, anything that they have leverage on. So the way to reduce that risk is either get rid of the debt or put yourself in a position where you've got enough savings and cushion to float any kind of drawdown, just like we would on intraday trading. You want to have enough capital in your account to be able to get you through any drawdowns, and really paying attention to what your max drawdown is a good way to kind of keep yourself in check to see, okay, well, it's been kind of a rough week, and where am I in relation to my most recent max drawdown, or the worst drawdown that I have had, and how can I put some limiters in place to reduce those drawdowns. So with my trading, I've put more emphasis on limiting the downside risk and the drawdowns than I do maximizing the gain. So I may miss out on some winners from time to time, but I also keep, I like to say you gotta keep your net worth kind of going up and to the right, keep your assets trending up and to the right. And with your trading, a lot of times people can kind of get stuck at like that treading water zone. And so if you're in a position where you can at least mentally let your winners run, and I guess more than mentally, but actually let your winners run, and that's not the inhibitor, then really cutting down your drawdowns is going to help still give you opportunities for winners, but also cut down on those valleys. So I guess one example of that is last week I put on some puts underneath or on this touch of the 50. We had an inverted hammer, pretty no-brainer there at the 50%, targeting. With the target down here at the negative 23. I took them off, before the big sell-off on Friday, so missed out on a little bit of profit. But instead of looking at it as, oh, there was another, big leg down here on Friday, a big sell-off into the close, seeing it as, what did you started with 0, you put the position on, and you walked away with 2x or 3x or whatever your multiple of your risk was. So I don't really dwell on well, I made 3x, but I could have made 4x or 5x. If it's a reoccurring theme where you're getting out of trades early and then they keep ripping, okay, there might be something that you can do as far as trailing your stop so that you can stay in the trade longer. Trail each candle or trail swing highs or swing lows, something like that to stay in those trades longer. But for the most part, if I get out and then the trade goes another couple of points or even 5 points, 10 points, you're just trying to get the meat of the move or a big chunk of the move and be able to repeat that over and over again. So the put position was, kind of like I said, kind of a no-brainer. 50% at the halfway back here, or inverted hammer at the halfway back. But this risk over the weekend of the Silicon Valley Bank is not so much a risk to a recession. Like if we go into a recession whenever, that doesn't really affect things in the way that people think. So the economy takes time to change direction. So you've got something like 2020, March of 2020, where we had the sudden jolt from COVID, but the stock market's going to react quickly, but something like the housing market is going to react really slow. And other areas of the economy are going to take a lot more time to react. So I know we're going a little bit bigger picture here, but when we get in these situations where people are thinking about panicking, and when you're a trader and you're in the weeds, sometimes you can, people can make some drastic decisions when things get a little bit scary, and you might be, trading and all that, and then you go over and you dump your 401k and you do something silly. So it's good to have a little bit bigger picture once in a while and just keep tabs on, okay, where are we at in the bigger picture. So if Silicon Valley Bank were to not be able to pay out its depositors, now you have all these tech firms that go under, and it's like, okay, that's not good. The company's folded, but more importantly is the next 10, 15 years of potential growth that could be stifled because there's just an inability or a very decreased ability for innovation and tech and that kind of stuff to grow. Thus, the U.S. economy really slows, and you could really go into a much bigger long-term period of just kind of stagnation, where just the economy is not growing. So this week, as far as trading goes, we've got expiration on Friday, and this week where we have rollover week is always a little bit funky because you have both contracts. You have the March and the June. So everyone should be trading the June right now because that has more volume than March. Last Friday, the contracts kind of roll over, and so the June contract has more volume than the March contract. One thing you can do when volatility increases, now volatility really hasn't gone up that much, but if things were to shoot up and you're all of a sudden in the 40s of VIX, you can cut your position size in half and double your stop, and that will keep the same ratio, the same risk amount as you were taking. So you don't need to quit trading or stop trading when volatility changes. I like to just kind of pause briefly when there's kind of a big, shock to the system, as opposed to reacting and saying, oh, I gotta, dump all your tech stocks and this and that. That is not the time to be going into panic mode. And so one thing I wanted to touch on Friday, we actually had a Bitcoin move down to its 50%, and we had a hammer. I chose to do a buy here at the 20,000 level on this hammer 50% touch, and at the time, anytime you come down to 50%, it might seem a little bit scary, and you might have some fear in doing it. But for any of you who've traded, intraday, you know that you get these opportunities where the market pulls back to a halfway back or a 50% retracement, and you can drastically cut your risk by getting in and being more objective about it and not being concerned with those emotions of the fear at the 50%. And so yeah, chose to buy with just the intent of you know taking it more of as a swing. And with cryptocurrency, there's you're not getting a dividend, so it's a little bit advantageous to take some, not so much day trades. I don't really do with the currencies, but cryptocurrencies, but you know swing trades that are maybe a week or a couple of weeks every once in a while are kind of nice. So um, just wanted to kind of touch on that. As far as day trade goes, on Friday there was a halfway back at the it was like 7:30, 7:50, I think, down at lows off of a low tick here. And so same concept. The market's coming down. We got a low tick. We broke the swing high, broke the opposing 61.8. And so, yes, the market was trending down, but these early indications of a low tick and a break of a swing high is saying, hey, there's a chance that, there's a really good chance that we could, pop here. And even if we don't get a 50-point move up and return to highs, we could at least get a bounce that takes us a worthwhile trade. And so taking this 38.83 and a quarter, and then running that up was just by trailing the swing lows is a nice trade, a nice way to kind of go about looking at the larger picture, but then incorporating your entries on the 512 tick chart. Fast forwarding to today, I really just did mostly observing. There wasn't a 15-minute opening range breakout because we traded at the prior day's close, at Friday's close. It did pop a bit, but here. But nonetheless, let's see. Get this after hours turned off. There. Now you can see it. So we filled the gap. We did pop, but with all the activity over the weekend and anticipation coming into today, decided to just kind of sit tight and take a kind of the observing approach, and we'll see what the market brings this week. So a little bit increased volatility this week. I'm going to keep everything the same as far as position sizing and stops and all that stuff at this point, but just kind of giving you a heads up of what can you do when volatility goes up. Definitely looking at buying puts when we rally to these halfway backs, especially we get kind of a bearish bar at that 50%. So you can see the next 50% retracement short would be 39.61 on the ES. However, this week things could be a little bit wild, and you typically get the biggest up moves in the context of a downtrend or a down market. So we may be all over the place this week with some gaps and some, high-flying rallies, and then the next day bigger sell-off. So I'm not going to be super eager to, get heavily directional one way or another. I'll kind of lean on intraday for that, but there's certainly no need to overtrade this week alone because coming out of, even if you have like a 2-week, like the COVID sell-off in March, you have a week or two of some big volatility, and then things settle out a little bit. And if you just take a couple trades in that window and you don't overtrade and shoot yourself in the foot, then you can come out the other side just kind of continuing on your trajectory. So I've got that Bitcoin swing working, keeping in mind expiration is Friday, so I'm going to be a little bit cautious as is, aside from all the banking stuff that's going on. And then intraday, I'm just kind of watching the 1-minute chart as well, looking for hammers and inverted hammers as places to get in either at a halfway back, a 50% retracement, or at the highs and lows of the day, whether it's a double top or just coming up and making a high price with a high nicey tick. Those have been working well the last couple of weeks also. So if you have questions, drop them in the comments below. Kind of a longer video this week and some big picture just kind of conversation, but there's really not, if your time frame is 10, 20 years as far as longer term, like your 401k or whatnot, there's really no need to panic in these times. If you wanted to convert to cash, it was a little late for that as far as like getting out at the top. Well, you're probably not going to pick the top as it is, so better off to just raise your cash reserves and make your 3.5%, 4%, probably pretty soon to be 5% on your money, and just raise up those cash reserves so that you are in a safe place if things do get a little bit rocky. So hope you have a great week of trading, and we'll talk to you all soon.